Today we're looking at 3 simple approaches to investing. These aren't strategies per se, really just some general ideas about ways to maintain your portfolio in order to tackle the vagaries of the financial markets, things like risk and volatility. Make sure you watch to the end of the video so that you get to hear all 3 ideas. Hello, I'm Peter Martin with Trading 212, and we add videos about investing to YouTube regularly. If you haven't already, make sure you subscribe to our YouTube channel so that you'll know when we put out new content. Well, the first of these 3 approaches is fixed cost averaging. This is also called a dollar cost averaging, or you can think of it as a kind of drip feed way of investing. So what we're doing here is that we are investing a fixed sterling or dollar or euro amount into our investment or investments of choice. And the financial markets, stocks, shares, prices can go up as well as down. We don't know what the future holds, which is to say there is an element of uncertainty in investing. But by investing a regular fixed amount, it means that when prices go down, we're going to be buying more. When prices go up, we'll be buying less. And this can help to smooth out the effects of volatility. So let's look at this in a bit more detail. Here is a daily chart of a FTSE 250 tracker. This is an exchange traded fund, an ETF. As you can see, the value has varied over the course of the year so far, as we might expect. And if you wanted to invest a lump sum, you run the risk of buying at a peak. So there's some kind of timing risk there. So what we could do to try and mitigate that risk is to instead break up our investment into regular small investments. So let's look at some sample numbers for that. Here we have a table of sample figures to illustrate regularly investing a fixed amount. So let's say a hypothetical investor wants to invest £1,000 per month in the FTSE 250 tracker. Now, these are all 2019 figures. And this is the price at the beginning of the month. For his £1,000, he gets 35 shares. He has to invest in a whole number of shares. So the most he can invest is this amount without going above £1,000. In the next month, he adds 31 shares to this 35. So his total holding is 66 shares. And at the prevailing price, that means his whole investment is worth, at that point, this amount. So the average cost per share over this 6 months is £30.79. The total number of shares is this amount, 192, and the total amount that he pays is £5,912.03. And so his whole investment is worth this amount, and this is what he paid for it. So his running profit that he's sitting on is £47.65. Now, there's nothing magic about all this. Ultimately, if the investment falls, he will lose, and if it rises, he will make money. But it is a nice, disciplined and orderly approach that spreads out the timing risk rather than investing one lump sum all in one go. The second idea is to diversify. Diversification is a widely adopted approach by many investors. And I've actually got a video all about diversification, so do check that out if you haven't already. But the general idea is that if you've got a nice wide cross-section of investments in your portfolio, then you reduce the chance of them all underperforming at once. You increase the chance that when some underperform, others in the portfolio will take up the slack by overperforming. And you can diversify by having different asset classes in your portfolio, and you can diversify within those asset classes. So let's take a look at that in a bit more detail. When we're diversifying a portfolio, there's more than one way we can do it. One way is via asset classes, putting our investment capital into different types of assets, such as cash or cash equivalent, fixed income, such as bonds, and equities. And we're basically talking about the stock market there. Now, historically, equities have given the best returns over the long term, but they are more volatile than these other two. How much you would put into each depends on your own risk profile. Do check out my video on investor types in order to learn more about this. But we can also diversify within asset classes, diversifying what types of equities that we buy. So let's have a look at that. To illustrate diversification within an asset class, let's look at 2 sample portfolios. The first of which is not well diversified. It has Boeing, General Dynamics and Lockheed Martin. They're all in the same industry, the aerospace and defense industry. Delta Airlines and Southwest Airlines are in a different industry, the airlines industry. But all of these are within the same sector, the industrials sector. And so if something bad happens to, let's say, Boeing, there is a good chance that it might adversely affect one or perhaps more or all of the companies in the portfolio. In comparison, the second portfolio is better diversified. It still has Boeing in there, but none of the other companies in this portfolio operate in similar spaces in the economy. Gap is in the apparel retail industry within the consumer discretionary sector. Wells Fargo is in the banking industry within the financial sector. Duke Energy is within the electric utilities industry within the utility sector. And Cisco Systems is within the communications industry within the IT sector. So if something bad happens to one of these different areas, there's a pretty good chance that it won't have necessarily a knock-on effect on the others in the same way that we saw in the first portfolio. The third approach is to regularly rebalance. The idea here is that after a fixed period of time, let's say every 6 months or every year, you're going to tweak your portfolio. So after this fixed period of time, you would look at the makeup of your portfolio and adjust as necessary to maintain your desired asset allocation. So let's look at this in a bit more detail. So here are some sample figures to illustrate an aspect of rebalancing. Let's say that we have a hypothetical investor who has decided their target for how they want their investment portfolio to be divided up is 2% in cash, 68% in fixed income, and 30% in equities. So just to make these numbers quite easy, let's say that they have £50,000 at the start of the year. So this would work out as £1,000 in cash, £34,000 in fixed income, and £15,000 in equities. And they check at the end of the period, let's say it's the end of the year, and the cash has increased to £1,015. Fixed income products have increased to £35,904, and the equities holding is now worth £16,800. So the percentage makeup of the portfolio has changed because of the outperformance of equities. This is now worth 31.3% of the portfolio. Fixed income is now 66.8% of the portfolio, and cash is just 1.9%. So here's the rebalancing aspect. They might decide that they want to keep it in line with these targets, which means they're going to have to tweak things a little bit, sell out some of these equities because they may be feeling a little bit overexposed now, and just move the funds over into fixed income and in cash just to bring the percentage holdings back in line with these targets. Another hypothetical example looking at rebalancing, this time looking at the equity portion of a portfolio. So this is very simplified. A hypothetical investor's portfolio with just 5 stocks in Vodafone, HSBC, Antofagasta, Rolls-Royce, and National Grid. And this time they have £10,000 devoted to equities, and it's divided up equally, £2,000 into each company, so 20% in each. And let's say after 6 months, they take stock, they monitor what's going on, and they see the values have changed to these that are shown. So Vodafone has decreased its proportion to 16%. HSBC has maintained its portion of the whole, but Antofagasta has increased to 22%. Rolls-Royce and National Grid are at 21%. And what the investor does at this point is down to the individual. Perhaps they decide that these are within a tolerable amount and make no change. They just sit tight and then maybe monitor in another 6 months. And maybe after 6 months, they see now that it's increased more substantially in favour of Antofagasta. It's at 28%. And that now Vodafone has slipped down to 12%, and HSBC is at 18%, and the other two have held at 21%. Once again, down to the individual, but maybe at this point the investor decides my exposure now is a little bit too much to Antofagasta, time to tweak things a little bit. So they may decide to sell out some of that Antofagasta and redistribute it slightly into some of the others. They might do some analysis and decide that Vodafone is doing poorly for a reason and they don't want to put any more money into that. Maybe they buy a new stock entirely and increase the number of stocks in the portfolio. Really, the key takeaway is to be doing the regular monitoring and adjusting as you see fit. I hope you enjoyed listening to these 3 simple approaches to investing. If you did, please hit the thumbs up button and give us a like, or why not let us know what you think about these 3 ideas by sending us a message in the comments section. We do read each one. But that's all for now from me, Peter Martin and Trading 212. Thanks for watching. I'll see you next time. Goodbye.